In this video, I'm going to talk about why young people today can't afford a house, why this peak can be explained by the weight of the baby boomers generation, why the central banks trying to help inflated a bubble, and what you should do about all of this. This is the baby boomer roller coaster and the money that you can make from it. Here, you can find the different generations. We're going to focus on the baby boomers because of this. The population growth, who was already coming up before the Second World War, exploded after it. It peaked at 2.3% before quickly going down. That's the baby boom. But when you get this wave of population growth, you have to make some room. So the silent and lost generation had to make some efforts. They built factories, schools, and houses to feed, educate, and shelter their children. The population boom led the 50s and 60s economic boom. The population surge was violent. In 1970, 38% of the global population was under 15. This transformed the age pyramid from an arrow shape into a triangular shape. And this had a big impact on the economy. Gen X and millennials also influenced the economy, but as the baby boomers were the first to be so many, they had a greater impact. For instance, new factories and schools had to be built for the baby boomers, but were already there for the following generations. I think these impacts are visible on the 10-year treasury rate. I use it because it's a convenient measure of inflation plus economic growth. This peak is usually explained by monetary policy, Vietnam War spending, or oil shocks. But another factor may be the baby boom, because all the babies born in that period were consuming goods and services without producing much. So companies had a lot of demand, but they were struggling to find some workers and capital to answer this demand, fueling inflation. As a result, rates climbed through the 1960s and 70s, peaking at 15% around 1980. Then things shifted. By the mid-70s, baby boomers started entering the workforce. This eased pressure on companies, which could now hire more workers and expand output. These workers could now save and invest, easing pressure on the capital market. So rates began to fall, dropping to 8% by 1990 and settling at a gentler 4% by 2000. Pressure on rates were relieved. So let's sum that up. The baby boomer population surge explained quite well this peak. The base of this thesis is that this cohort has continued and will continue to influence the economy. In the 90s, boomers continued to grow their wealth for their retirement, pushing rates down even more. And after that? Well, after that, things happened. So if we focus now on the economic growth, it was not what it used to be. In the 70s, the post-war boom faded out, and the one who knew the golden era with its 5% growth were eager to get it back. So when growth continued to go down again and affect the standard of living, central banks thought it was a good idea to take some action to help the economy. So they intervened massively at each economic weakness, making the central bank's balance sheet multiply by 5 in 15 years. That's a big cost for long-term growth that was not really going up. So why did they continue to do something that didn't work on the long run? And where all the money go? Well, it went to asset markets, mainly real estate, bonds, and stocks. For the last 25 years, asset market went up, and the baby boomers, who had already a lot of assets, were the main beneficiaries of this. As they were the major political force, they pushed for more of these interventions. The result is, on this graph, Gen X have today half the wealth the baby boomers had at the same age, and I don't even talk about millennials. But as we saw, this wealth creation was not coming from growth, because growth has been going down for the last 50 years. It came from debt. During the last decades, different actors in the economy levered themselves up. Corporation took on some debt, then household, and now it's the government who is taking the most. Up to what extent the economy has been leveraged? We get an answer with this chart, coming from this McKinsey study. It shows the net worth of a country relative to GDP. Let me explain. A country net worth is roughly made by real estate and fixed assets. If you divide this by the GDP of the country, it will give you how expensive or cheap these assets are. A sort of price earning at country level. The black line is the average of the sample. It stayed around 4 up to 2000. Then it went from 4 to 6 after that, exactly when central banks started to go unconventional. Because of central bank policies, assets are now 50% more expensive. But I think it will go into reverse. Why? Because the baby boomer generation is aging. They were the first to be this much used, creating this, while now they are the first to be this much retired people. The last baby boomer just turned 60, and the average baby boomer is already retired. And for the times, they are changing. For years, baby boomers have been accumulating wealth, making asset market going up. Now that they are retiring, they need to take out the capital to live on. The buying pressure is switching into a selling pressure. So is that bad? Well, normally, pension funds and politics have anticipated it. Normally. What may have been forgotten, though, is that for the last 15 years, markets have been artificially inflated by monetary policies. So how is it going to unfold? In one word, inflation. Again, because when you retire, you produce zero while still consuming. Less people producing with still some demands leads to, well, you get it. But government would protect us from inflation, right? Well, they have been accumulating debt for the last 15 years, and they may be happy or forced to get rid of it with inflation. Also, fiscal spending is quite popular, at the beginning, at least. So let's sum that up. More than any generation, baby boomers have accumulated wealth, but in the last 15 years, this wealth growth has not been followed by production growth, making this ratio go from 4 to 6. It was financed with debt, making the economy over-leveraged because of monetary policy. The baby boomer generation retiring is going to provoke an asset market selling pressure. Doing so, they may unwind the over-leveraged asset market, pushing it down even more. This is, in essence, the baby boomer roller coaster theory. And what is going to happen exactly in your country? Well, it depends. First, it depends on the age pyramid. Here you have 3 countries affected by a baby boom: Japan, Germany, and China. The age profile is different, hence the timing may be different. Secondly, the evolution of the ratio has been different for each country. The case of the US is not the same as Japan or China, so implications are going to be different. Lastly, each country has a different average asset composition. Asset classes may be affected differently, so a more refined analysis has to be done for each country. But globally, we can draw these general guidelines. Better invest in a country not affected by an elderly boom, avoid normal assets like real estate, bonds, and popular stocks. Shelter could be commodities, emerging markets, small caps, value stocks, or cryptos. And lastly, the cleaning of the balance sheet is going to induce some volatility, hence opportunities. Thanks for watching.